Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's check in on what we're doing with this market. I'm bringing in Gina Martin Adams. I'm just going right to the A team, for Bloomberg Intelligence. Gina, I left Thursday. I don't work Fridays in the summer, as you well know. I come back and the world's, what happened? We left Thursday with a nice soft landing discussion.
Right.
You know, the markets, maybe we'll get a little friendly pullback. We come in today and, you know, I had the NASDAQ off more than 1,000 points earlier this morning.
Also, the last 3 trading days, the NASDAQ's lost 7%, so it's its worst stretch since June of 2022.
Well, I think one big thing happened, and that was tech disappointed forecasts.
Okay.
I think that this has been actually underway for more than just Friday. Friday was an exacerbation of trends that really started a couple of weeks ago. We wrote a note early last week and we called it 4,344 reasons tech stocks may struggle with high expectations, because tech stock valuations are 4,344 basis points above recent 5-year average. Wow. It just got to the point where valuations were so extreme in an environment where tech stocks were nearly faced with impossible expectations. Now, what's interesting about the earnings season is all the tech stocks beat. Mm-hmm. They beat forecasts for second quarter earnings, but they were unable to sustain forecasts for going forward margin growth. And they started to talk about how much they're going to have to spend going forward, and will they need to cut capex, and they're going to right size AI expectations. And that created a tremendous amount of uncertainty that was then exacerbated by 2 big macro indicators last week. The ISM, which fell back to 2023 low levels, which unfortunately would suggest the manufacturing sector's sort of nascent, tiny recovery that it kind of sort of emerged by March, is now kaput, and we're back to 2023, which was clearly a recession in the manufacturing sector. And then also the employment report, which, you know, honestly, I'm kind of shocked by the degree of extreme exaggerated move that we've had to the employment report, because all we're seeing is slowing job growth so far and still extreme entry into the labor force, which is resulting in modest uptick in the unemployment rate. But we are seeing a slowdown in average hourly earnings growth, which may cause questions about the consumer. The other note that we wrote last week is Amazon is entirely holding up the house of cards of consumer discretionary. So I think that also played out last week, is when all your hopes and dreams are on one stock and that stock cannot sustain expectations, and then the consumer outlook starts to deteriorate somewhat, you see some real weaknesses emerge there.
And I'm glad you brought up earnings, because overall, if you look at the S&P 500, as you know, 12% earning growth year over year here. But you've talked so much also about when people want to argue about the broadening out, and but then when you're looking on the fundamental side, what you're seeing beyond tech, as you're seeing kind of that growth is supposed to narrow between tech and the rest of the index. So what improvements are we seeing in other components?
It's actually really fascinating. And I think that this is part of the reason, as much as it feels so painful, this market meltdown has looked very different than the meltdown of last fall. Remember, we corrected 10% in the third quarter of last year as well. It seems like a distant memory because we've had such a great year in stocks so far. But we did have a 10% meltdown led by tech, but the market's decline was 1-for-1 with tech. This time, tech has doubled the decline of the market. And so there is some internal rotation that's quite different, characterizing the 2024 tech meltdown and the overall market impact relative to 2023. And I do think that that's because of the cyclicality of earnings. Whereas in 2023, when tech melted down, there was nothing to kind of hang your hat on, because the rest of the sectors were producing accelerating downside on earnings. Today, that's very different. We're actually seeing earnings growth improve. So Mag 7, the 493, are posting 7% earnings growth. It's the first positive quarter that we've seen in more than 4. So we're starting to see some earnings. The most fascinating part about this earnings season also is guidance. As much as I think the market narrative has been, oh, the companies are guiding terribly. No, the reality is that tech companies have been guiding us to expect less. but the rest of guidance is actually net positive. We're actually seeing positive guidance momentum emerge in the rest of the groups. There's going to be so much confusion as to how this plays out if we do indeed move into a state where we're seeing accelerated layoffs, we're seeing much greater jobless claims emerge, and that's going to imply that maybe we have some actual employment losses around the corner. That's going to create a lot of confusion in this market if we get there, but that's not where we are right now. Where we are is actually companies outside of tech are showing still improvement in their outlook.
We had a guest on earlier this morning that a fund manager just flat out says his note to the clients is buy the dip.
Yeah.
It's pretty bold. I mean,
listen, when you get to a VIX, that's the highest level since COVID. It's very clear that there is panic right now in the equity market, and panic usually results in major buying opportunities. So I completely understand that. We haven't even seen absolute non-farm job losses yet, and the market is already completely and totally panicked. And this is really because tech really drove a lot of our optimism. It was the only source of optimism. Now we're starting to see those tech stocks melt down, and the market is completely panicked. Although you could have bought NVIDIA at the open today at 92. It's trading at 98 today.
There we go.
Right now.
Intraday. Yeah, Andrew Tyler over at JP Morgan's trading desk, so he made that tactical call this morning about buying the dip.
Did? Yeah. Interesting.
Yeah, so we'll keep an eye on.
I remember being on a desk in 1987. Don't now pick up the phone.
Right. Did you start right before the 87 crash?
Yes, I did. And I was on the floor at 87, October 19th. So anyway, Gina, thank you so much for joining us. Really, really appreciate it. Gina Martin Adams, she is our equity strategist for Bloomberg Intelligence. We really appreciate getting a few minutes of her time. Michael McKee joins us here, and he does all the economy stuff for Bloomberg Television. Mike, I left the studio Thursday. All my discussions were soft landing, some variation of soft landing. And then today, people are talking about a recession.
Well, it's only Gina's people.
Yeah, exactly.
It's only the equity market. You were talking about 1987. I made a reference this morning when I was on with you to people opening the windows down on Wall Street. And I got a note from a trader who's been around for a while who said the 22-year-old sitting next to me had no idea what you were talking about.
Yeah, exactly.
So maybe we come up with a different analogy.
Right.
I said just a minute ago it's an Emily Latella moment now because we got the ISM Services Index. Now there's another reference nobody will get. She was the Gilda Radner, comedian on Saturday Night Live, who would come on and say, "Never mind."
Right.
And the services ISM comes in and everything is higher, including employment, and that was the thing that everybody worried about on Friday, and with the ISM factory orders on factory index on Thursday, and production's up, everything is up, and that number comes in better than expected, and that's 2/3 of the economy. So soft landing might still be in the cards. I think probably what you're seeing, and I'm going way beyond my level of expertise, is that Gina Martin Adams is right, and that the equity markets were overly dependent on a few stocks that then didn't have great numbers, and you put the data on Friday behind them, and everybody panicked, and now maybe they don't need to.
Also this morning, when we're looking at the yield curve, as I'm sure you saw as well, Mike, it's turning positive for the first time since July 2022, if you're looking at the 2s, 10s part of that. So isn't that something also that you would potentially want to see as far as what that means for the direction of the economy after it was inverted for so long?
Well, yes and no. What people don't realize is that the yield curve disinverts right before recessions because people are anticipating Fed action. And I think that's one of the reasons we saw a big move. It's been slowly flattening, but I think today it was basically the 2-year went way down. The 2-year yield went way down, people anticipating the Fed would be cutting rates and maybe an emergency rate cut and things like that. And right after this ISM number came out, it went back to where it was yesterday. So we're either slightly positive or back to slightly disinverted. So I'm not sure that's a signal, but there are a lot of different signals you can point to these days, one way or the other. And I had an argument with another strategist this morning over the Bloomberg. who was suggesting the Fed needs to act now, and I thought, don't you think it'd probably be good for them to wait a few days and get a little more data and see if this is just a panic or a real collapse? And I think the waiting part is what the Fed is going to endorse.
It just reminds us, how rare is it for the Fed to do an emergency, like intra-meeting kind of rate cut or increase?
Very rare, and they only do it when the market stops functioning. And that's what we saw during the pandemic in March of 2020. That's what we saw in the fall of 2008 when Lehman Brothers went out of business, and we saw the market seize up there. But there doesn't seem to be any indication that you can't trade today. So as long as you can trade, that's what the Fed is concerned about. If you lose money, that's your problem.
Exactly.
Not theirs.
Well, you also spoke to Austin Goolsbee on Friday. He spoke again this morning, but kind of unpack for us what he and his reaction to the jobs report, because it seems like, again, they follow trends, and that was just one report.
Well, it was interesting because Goolsbee has been one of the more dovish members of the Fed, suggesting that they needed to start the process of normalizing rates, and yet he wouldn't really go there on Friday. He didn't want to front run what they might do. He said, we're okay with where we are. Let's see what happens in the rest of the data. And he had a vote this time, filling in for the vacant Cleveland seat, and he did not dissent. He voted for the Fed to hold rates where they were. So if one of the biggest doves was okay with it, then probably the rest of the Fed is going to be feeling okay with it for the moment.
Right. All right. Very good. Michael McKee, thank you so much for joining us. Michael McKee covers all the economics for Bloomberg, and we appreciate getting his thoughts here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So Jess Menton sitting in for Alex Steele here for the next couple of hours. Again, John was just reporting this ISM data. It came in better than expected. Let's go right to that because we could use some good news here. Steve Miller, chair of ISM Services PMI. It seems, Steve, some pretty solid results. What do you take away from some of this ISM data?
Yeah, we were certainly happy to see it return to expansion territory. It seems like things are moderating in terms of feedback that we're getting through the survey. We saw, from a GDP standpoint, kind of almost dead even, those that were in expansion versus those that were in contraction, with just a slight percent, about 3% higher on the expansion side. As you see in the number, it's just slightly above in the expansion range. So happy to see it's less volatile than we've seen in the past. With last month, it was about 10% higher GDP represented in the contraction territory versus expansion.
And when you're looking at the Atlanta Fed's GDP Now model, obviously we know that's volatile, but still the next update's going to come later this week, but it's around 2.5% for the third quarter. So I know there was a lot of concern when we had some of the manufacturing data last Thursday, obviously the jobs report on Friday, but when you still have economic growth forecasted to be pretty solid here, how do you sort of unpack some of the latest wave of data here and how this latest, when you're looking at ISM, sort of fits into this?
Yeah, so on average, for 2024, what we're seeing is gradual expansion. The latest reading is about, I believe it's 0.8%, represents about a 0.8% increase in GDP growth. So I wouldn't be surprised to see that kind of a growth number. But certainly what we see in our survey data on average is continued growth in GDP.
All right, Steve, thank you so much for joining us. Really appreciate you coming on and breaking down some of these numbers for us. Steve Miller, chair of the ISM Services PMI. Again, some better than expected services PMI. 51.4 was the actual reading. Consensus was 51. Last period was 48.8, so a nice improvement there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney here on Bloomberg Intelligence Program. We're live on the Bloomberg Interactive Broker Studio, streaming live on YouTube as well here. And John was just talking about the 10-year Treasury, 3.75%. We were low at 3.66%, so it's moving all around.
That's right.
There today in the yield
We missed
curve.
that 5% mark, Paul.
Yes,
Our
exactly.
timing is so bad.
Exactly. All right, next guest joins us here in studio, making a big trip over the pond. Chris Watling, CEO and Chief Market Strategist for Longview Economics, based out of London. We got him here in the big town. Chris, thanks for coming into our studio here. What do you make of the last several days here? It's just been a real readjustment for the market in terms of its outlook.
Yeah, I think it's fascinating. I mean, it seems to me we've evolved from sector rotation, which was kind of a mid-July theme, to really a rout, to a liquidation event. And as we were saying just off air, it's really all about the Bank of Japan's governor, Ueda, who came out. They surprised markets with a 15-bit hike. But then, of course, on top of that, he talked about the idea that neutral rates are a long way away. So in other words, there's a rate hiking cycle. And he's done that into, it's very interesting. So the Fed's talked about cutting, and we got a bit of that from Powell last week, a bit firmer. And the BOJ's raising, and they've done that into two extreme positionings in markets. Everyone was short the yen, and everyone was max long the Mag 7. And both those rate cycles changing influence that positioning. So it's like we're in a giant repositioning in global markets and a giant liquidity event on the back of it. So there's a lot going on. It's pretty interesting. Not to mention the macro data, which we haven't even got to.
Right. Well, looking at the Mag 7 index here in the terminal, down almost 5% today, so on pace for its worst day, actually since July 24th here. So keeping a close eye on that. But also, you moved neutral to U.S. equities in late July. Actually, it was ahead of the Federal Reserve's decision last Wednesday. Kind of unpack us how you're advising clients to position. Where are you telling them to put their money? And what would you want to buy? What would you want to sell at this point?
Well, I think it depends on obviously your time frame. So if you're sort of next couple of months, I'd just be cautious. I think markets haven't finished their sell-off today. We're in the midst of it, and there's more to come. And generally, when markets sell off this sharply, the price action dictates you get a retest, unless we get something dramatic out of the Fed in terms of intermeeting cut or very dramatic strong signaling. So short term I do that. In the medium term, I think one wants to see this as an opportunity to start moving portfolios around in terms of that global sector rotation. So our view is that markets have fashions. Every 6 or 7 years, the global sector leaderships change. And it's been tech, it's been strong. And we think it's now starting to change. We're coming into a rate-cutting cycle. I think you're going to get cyclical re-acceleration in the West. And, we think people should start positioning for that. That's small and mid-caps in the US. That's overseas equities, non-US equities. So I think the headline is we're going back to the noughties in terms of what does well. Mm-hmm. It's like Back to the Future all over again. But what goes around comes around. And I think we're going to get a consumer and housing boom over the next 1 to 4 years across the Western world. And that's going to change the equity sector leadership in the global stock market.
Looking at the VIX here, it's up about 19 points to just north of 42. It was up to a level of 65 earlier this morning, just blowing out like crazy. Does that tell you that panic is out there earlier today?
Well, there's definitely panic, isn't there? 60 is a big... I remember when I started in this business, if it went over 20, you thought it was a big number. And then, of course, that's all changed. But 60 is undoubtedly a big number. Very, very rarely do you get above that. So I think very short term, what people want to watch is do you get a bullish key day reversal in markets today? Obviously, they've opened below the lows. Do they close above levels that they saw on Friday? It seems a long stretch from here, but still a few more hours of trading. This market is very volatile. It can move a lot very quickly. But look, most sell-offs happen in 3 or 5 waves. So we've had wave 1. We're going to get a relief rally. If you're a trader, at some stage over the course of this week, you want to get involved in that on the long side.
When you're talking to your clients, what are some of their top questions right now?
Well, I haven't talked to many today because I think the questions might have changed over the last 12, 18 hours. But no, we've been the big question has really been when do you get out of the Mag 7? And I think that's becoming increasingly obvious. And of course, I think the really big question will be now, has the psychology really broken in that sector? Is this genuinely the top on a relative basis for the Mag 7? I would definitely argue it is. because it happened on July the 11th, on that CPI day, when we changed, better inflation and so on, and better, therefore, interest rate outlook for the Fed. But look, I mean, there are tons of questions. People are going to be asking about this liquidity out of Japan. They're going to be asking about neutral rates in Japan. What does UADA mean? And we're going to be looking for Fed and other central bankers to accelerate their rate cutting talk, I think.
I'm glad you brought up July 11th, the CPI day, when we got that last report for the month of June, because if you look at the flows data, a lot of that rotation, of course, people were talking so much about small caps last month, but now they're coming under pressure. But those kind of income-driven type proxy bond-like sectors, if you're thinking about utilities, real estate, a lot of flows going into that. Even last week, if you counted both of those sectors with Bloomberg Intelligence data, it was close to about $1 billion going into those two sectors. And then if you looked at technology, there was a little bit of a bid for the buy the dip. There's around 300 million that went in that sector. But when you're thinking about the bond proxy type corners of the market, I mean, are we still clearly seeing rotation? It's just the rotation's now continuing to move if you're pulling up at those expectations for when rate cuts could potentially happen.
Yeah, I mean, markets sell off, you go defensive. You go bond proxies, that's what you do. That's where you go and hide. So, generally, I always think of the market as cyclicals, defensives, and long duration growth. And, there's an argument you go defensive before you go into the cyclicals. But, it's no wonder we're seeing that. And I think that 300 million into tech they're probably regretting every penny of that right now. Look, I mean, I travel around the world talking to investors. Over the last 6 months, every single man and his dog has owned NVIDIA. And now every single man and his dog is probably selling it, if they haven't already. So
when's the buying opportunity then?
Well,
for a stock like that.
I mean, if you look at tech in 2000, when it had its major TMT peak, the sector derated relative to the market until 2014, which didn't mean you didn't not buy it for 14 years, but it just means don't be too quick.
So outside...
Sorry, I was going to say that is the absolute key question here for an equity investor. Has the psychology in the Mag 7 changed? Is global equity sector leadership changing at this moment? That is the crux.
Well, there's an argument to be made that if tech doesn't lead this market doesn't go anywhere. That tech is, by definition, market cap-wise, has to be a leader.
Well, that's absolutely right in the US, but outside the US, not. Right. So globally, the market can be led by other stuff. But you're right, the US will really, really struggle with that.
But I'm just looking at the European markets, selling off today as well here.
Of course. But interestingly, in the first 2 weeks of the tech sell-off, Europe held up really nicely. So, these things have phases. We're now into the liquidation phase. So you've got to sell everything. Gold's selling off.
Yeah, and you don't have in the European markets the tech exposure that they have in the U.S. market.
Not really.
That changes the trading dynamics, the valuation.
Exactly. The sectors are very different. We have ASML, but that's about it, really.
I like SAP, too. I like SAP.
Yes, we got a couple, but it's pretty thin.
Exactly. But you have the European companies have that exposure to China. To a greater extent.
They do.
Yep.
They do. We love Spanish mid-caps, just to go really random.
Spanish
really
mid-caps, okay.
No one's talked about Spain for 15 years, but the pigs are coming back.
Okay.
The pigs are back. You remember the pigs in the noughties?
Yep.
They're coming back.
All right.
What goes around comes around.
Very good. Chris Watling, actually, we're going to keep you for a little bit. So, all right, so as you travel around here, are you talking about European equities more than U.S. equities to the folks?
This year, we've started talking about European equities and UK as well. UK, I mean, I don't know how much you've seen of our riots over the weekend, so maybe people are a little off the UK at the moment. But actually, the UK is a very interesting opportunity because we're going to get a consumer and housing boom. And there's going to be great earnings growth. It's a cheap market. I would argue we have political stability. It doesn't quite feel like that in the last few days. Maybe our riots haven't hit your newswires, I don't know, but it's been pretty brutal in the UK over the weekend. But yeah, we're talking a lot about European, UK, even some of the emerging markets, but not in this liquidation event. This is when you pick them up on weekdays in this liquidation event if you're 1, 2, 3, 4 year investor. It's going to be a really interesting 4 years. It's going to be very different from the last 5 to 15, really.
So what do you tell people that woke up to this market and see this kind of volatility here? What are you telling those folks? That this is maybe perhaps part of a reasonable correction, or is there something else going on?
Well, to be honest, it depends on their time frame and whether they're a trader or an investor. But I think the really important thing here is this, just look at the yen. The yen tells you everything. The short positioning, it's the carry trade currency. Everyone's been funding short yen, long, Brazilian or Mexican, currencies or long Mag 7 or whatever it is. You fund out the yen. So you're getting killed at the moment. So this is very much a liquidity event, short term. It'll burn through. Hopefully the central banks will turn up. Then you start picking out what you want for the next 12, 18 months. And that is when we think about this move into cyclicals and move overseas or into mid and small caps.
So what's the next big sort of event that you're keeping your eyes on? Because obviously we have Jackson Hole, it's not till later this month, but we'll have a ton of different Fed speakers coming out, and then still a lot of consumer-related earnings in the US this week.
There's a ton of stuff going on, isn't there? Even though it's August, there's no going on holiday. Luckily I've been, so I don't have to worry about it. But yeah, I mean, I think, are we going to get an intermeeting cut? I think that really depends on how much financial conditions tighten and the price action in markets. What is the market pricing in? Are we going to potentially get 50? Is the market it's probably priced in 50 for the next meeting already? I don't know. I'm out of date. I've been to the screen for 20 minutes. But yeah, I mean, I think all of that is critical. The data is critical. ISM Services today was very interesting for the soft landing argument.
Came in better than expected. Hey, Chris, thanks for joining us here. Chris Watling, he's the CEO, Chief Market Strategist for Longview Economics, based in London, but he's doing his U.S. Tour here because we work during the month of August, unlike Europeans.
That's right.
So I'm just laying it out there, folks.
Paul's out on Fridays at the
beach.
I'm
going to Paris.
On Fridays, so we appreciate it.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well, so you can head over to youtube.com and search Bloomberg Podcast. I mean, who reports earnings on a Saturday? Only Warren Buffett could do that at Berkshire Hathaway. I was not paying attention whatsoever on the Jersey Shore, but somebody who was paying attention was Matt Palazola. He's a senior analyst, covers all the insurance geeks for Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker studio. So what'd you learn from Berkshire? I'm guessing more cash and even more cash?
More cash and even more cash. So the big story was really them selling half of their Apple shares. We had mentioned in our earnings preview note that we thought they might lighten the stake a little bit more. I didn't expect it to be this much, but that was the big story coming out of it.
And why was this? Like, what ended up being the kind of cause for them to want to pull back and trim that stake?
Sure, Jess. So we had mentioned also, they kind of telegraphed a little bit that they were probably going to sell more at their annual meeting in May. Buffett had warned about tax rates going up potentially in the future and maybe taking some gains off the table. Tim Cook was actually sitting there in the audience. It was kind of funny that they had sold, I think it was like 10 to 13% of their holdings at that time, and they got questions on it. And it just seemed body language wise that they would be selling a little more. So I think tax rates, Buffett's been a little weary on exposure to China for some companies. So I think those two played a big role.
And I actually had mentioned to you before when we were off air, kind of trying to pick your brain, because Apple, if just for people to remind them, it was underperformed the S&P 500 tremendously in the first quarter. It was one of its worst quarters relative to the index. It's probably like the fourth or fifth worst since the dot-com bubble burst. But then it bottomed in April and has been up close to 30% since then. And so the S&P 500 in that span has only been up about 4%. So you were saying you didn't think even just the rally that we've seen was as much of a factor either as far as why they trimmed their stake.
Yeah, I don't think so. I mean, Warren Buffett's not out there trying to time the market one way or another. He looks at these stock investments as if he's buying the company. So he also said at the annual meeting he expected Apple to be their biggest holding at the end of this year. It still is. So I mean, that stock was about 40% of their portfolio before this move. So I'm not surprised to see him take some concentration off. How
much cash did they have at Berkshire Hathaway today? And so any ideas what they might do with it?
Always a tough one, Paul. I think it's $278 billion, which I thought was a mistake when I first saw it, because they were at like less than 200 before. The sale of the Apple stake brought in a lot of cash. higher interest rates have taken a lot of pressure off them holding cash.
Yep.
I was calculating that just a simple after-tax return on the cash would help their earnings by at least 5% next year, right? So just holding it will be okay. They bought a big stake in Chubb. That would be an interesting mega deal. I'm not really predicting that would happen, but just seeing that, I think the next deal Buffett does is probably something we don't even really understand what it is, like, makes unique parts for some materials or something like that.
It's interesting too, because at a certain point, their holding in Apple was so big that it took up basically half of its portfolio. So in your kind of view, does it make sense to make a move like that?
Yeah, I don't know if anyone wants to have one stock make up, half of their portfolio. He had said he would love to have owned the whole company at one point or something. It does seem like he was worried about global economic situation. I think the timing of this is just kind of a coincidence why everything imploding today and this happening. Also keep in mind, Bank of America was also their second biggest holding. They've been selling a lot of that in the third quarter. So I do think he's really looking at concentration.
I saw some reporting, I think it was in the Times, about Bill Gates and Warren Buffett relationship maybe not as tight as before. Any thoughts there?
So what has been happening is Buffett's part of the Giving Pledge, where he gives away a bunch of his wealth over time. And
I am not. I'm going to spend every last dollar.
I'm not either. I don't have enough wealth to give away. So, but he was giving a lot of his money annually to the Bill Gates Foundation. What happened, I don't remember when it was. I think it was probably the end of last year. He had announced that when he passes away, that his children are going to inherit the shares in a foundation to be used for charity. I think before that, the Gates Foundation was, I don't know if it was official, but was at least thought was going to get some of that. I don't know about the relationship between the two of them. I just know that that was the case, and I think he's given tens of billions to the Gates Foundation over time anyway.
What about insurers? Because I always think about the insurance companies in relation to, obviously, Warren Buffett. If you look at that group, though, in the S&P 500, down about 3% today, but up 15% year to date. What kind of view do we have as far as how he views that particular corner of the market?
Yeah, so insurance is kind of the engine that drives the float for Berkshire Hathaway. They have a primary insurance business, they have a reinsurance business, and they have the auto insurance business, which is Geico. These companies as a whole, Buffett obviously loves that industry. They made a big play in Florida last year, which doesn't seem like they redid.
And today, hurricane hitting?
So hurricane, we have a note out on Hurricane Debbie. Not really a big deal for the insurance companies. Okay. Will be very minimal for Berkshire Hathaway, if any impact on them as a whole. But for the group, we seem to be hitting maybe peak ROEs, maybe this year and next year. The valuations generally peak before the ROEs do, so it seems like less rosy times ahead from a fundamental standpoint for the insurance companies. But Buffett hasn't changed his view on insurance at all.
All right, Matthew, thank you so much for joining us. Matt Palazola, senior analyst covering all the property and casualty insurers for Bloomberg Intelligence, joining us live here in a Bloomberg Interactive broker studio. Warren Buffett and the Berkshire Hathaway folks reporting earnings over the weekend. Again, huge cash haul. And for those of us on Wall Street, we're just like, how do you ever deploy that? I don't know how you ever deploy that.
I know.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Market's off 2.4%, the S&P 400. So a lot of folks are saying, is this just a natural, healthy pullback in what is otherwise a pretty solid market? Or is this the beginning of something more on the downside? People trying to get a sense there what's going on. Carol Pepper, founder and CEO of Pepper International, joins us from New York via Zoom. Carol, what are you hearing from your clients? What are you telling your clients on a day like today where we've had a big move in the markets?
Yeah, I'm telling my clients, keep calm and carry on. This is a little bit of a pullback, but not unexpected. When Warren Buffett went and sold half his Apple position, that made people nervous. But frankly, the fundamentals have not changed. The fact that there's a slight correction, nothing will go up every single day forever into infinity. And if you think that it will, then you shouldn't be in the stock market, because it never does that. But you have to look at long-term trends over time. Growth stocks, and particularly the Magnificent Seven, have done extremely well. Should there be occasional pullbacks? Yes. But does that mean that we're in serious trouble? No. So if you hold these stocks and you're nervous right now, this is not the time to sell. Obviously, even the plunge from this morning has pared back its losses. Some of this was the fact that a lot of the traders are on vacation. So whoever is in the market is moving things around much more than they normally would when it would not be in the middle of August.
What are the top questions you're getting from your clients?
Well, obviously, people wonder, is this the beginning of the end? Have we run as far as we should? Should we be pulling everything back? And again, I manage money for people with over $100 million who have single family offices. And we make bets, not unlike Warren Buffett, not that I'm as good as him, but we make bets for multiple generations. So again, if you look over the last 5 or 10 years, how much has growth and tech in the US outperformed everybody else? AI is the new entrant into the tech scene. It will continue to outperform. Will there be moments like now when maybe the market enthusiasm got ahead of the reality of where the price should be? Yes. But does that mean that it's going to plunge to zero? No. Are we having a dot-com crash? No. Why? Because there's actual earnings underneath these stock prices, whereas in the dot-com day, there was nothing underneath. It was all air. So for that reason, I tell people, yes, it looks scary. No, don't do anything. This is a typical August doldrums, buy the news, sell the news kind of market movement that we see almost every summer.
So where should people, if they maybe want to look for some values here in a market that's pulled back a little bit, where are you suggesting they go first?
Again, if you're underweight in tech, depending on your own weights, this is a great time to get into tech. If you want to get in, having the price drop 5 or 10%, terrific. Get in now if you're not in there. If you're not wanting to kind of test or bet when things are going to move one direction or the other, just sit in cash, let this settle out for a couple of days, and then proceed in an orderly fashion as usual with your investment program. So I'm telling people just to remain calm. I don't think this is the beginning of the end. I don't think Warren Buffett was doing something sinister. I do believe him. What he said, it was a tax move on his part to sell half of his Apple position. So, just calm down, everybody. It's going to be fine.
When you have the 10-year last week sliding below 4% for the first time since earlier this year in February, and then you have obviously income kind of driven type bond proxy sectors, utilities, REITs that were taking in a large amount of the inflows, especially since that CPI report on July 11th, as well as last week when we saw that sell-off accelerate the last few days. Are you putting money or suggesting clients put money in those particular corners of the market that would obviously benefit from rate cuts?
Yeah, I do think the rate cuts are coming, and I hope that we will go back to having at least 2 rate cuts this year, maybe September and November. So certainly if you're underweight your fixed income and you've been just relying on, good positions in your cash accounts, those rates are going to go down. So perhaps the time to consider getting into bonds a little bit. But again, you can never time exactly when that's going to happen. Will you hit it exactly? No. Who may hit it exactly are the program traders, not human beings. It's impossible to outtrade this market, so you can't be that smart. But if you've been sitting in very high cash yields and you're worried about where cash yields are going to go, which is down when they start cutting the rates, then yes, it may not be a bad time to put a little bit more into bonds. But timing that date is still going to be tough.
How about, I don't know if you have any views on crypto, but that's been whacked all over the place today with Bitcoin off about 8% today.
Yeah, well, again, there's fear days and there's greed days. On fear days, everything that looks risky, quote unquote, goes down. So crypto is considered a risky or a growthy asset. So of course it's been hit, but I know a lot of people who are buying massive amounts of crypto right now, particularly overseas. I work with a lot of international families, and there's a lot of reason why people are starting to substitute crypto, in some cases for their own currency, or using crypto to move money around the world. So that's going to continue to happen. For people that are hoarding crypto, this is a great day. They can go out and buy some more, and they all would project within 2 months it'll be back up into the 60s, maybe back to 65.
All right, Carol, thank you so much for joining us. Always appreciate getting your thoughts. Carol Pepper, founder and CEO of Pepper International.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So let's talk commodities here. Let's get the latest. There's a lot going on here across the board.
Mike.
Miami Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence, joins us on Zoom from Miami, Florida. Mike, what's your commodity call today when everybody's probably saying, what is going on out there in financial markets?
We're seeing sell what you gotta, not what you wanna, and that's really affecting. It's typically you've seen this happen in the past. When beta goes down to this velocity, you sell what you have to have. So that really started this weekend. Bitcoin broke below 60,000. It hovered there on Saturday and then broke through there on Sunday. So it was your indication. We'll start with the world's most significant leading indicator, and there's a lot of people who speculate in it. So that was like people had to sell that because they need to raise capital. You're seeing it in gold. That really started, similar beginning of 2008. When we had the financial crisis. The significance of things like gold and copper going down is they're perfect goddess sellers, but gold will probably do better. The thing is, managed money net positions, speculators are way long gold for a reason, because it's a bull market. So they're liquidating some of that, but I think it's more likely to cover. And the difference then is crude oil. Crude oil's hanging in there. It's only down 1%. On a day like today, we'd typically be down more than the S&P 500, but we know there's geopolitical tensions, escalating. And a lot of the futures positions were way sold out about a month ago. So crude oil is not way overweight long like gold is. So that's where you've seen some of the greater, I think, pressure on gold, at least for today. But in the long term, as this resolves itself, we see that if beta is clearly making a little bit of a high and volatility is making a bit of a bottom, gold will be one of the primary beneficiaries.
And looking over at the crude oil market, WTI for those U.S. futures falling to around $73 a barrel. As far as what could be coming ahead here when you're talking about looking at the commodities space, what do you think this tells us more kind of broadly about the economy and the potential direction here for the U.S. stock market?
Well, it's deflationary forces. And I'm glad you went there, Jess, because I've been writing about this for a little too long, but particularly this year, commodities basically predicted this. With gold going up and all commodities going down. The Bloomberg Commodity Index on a one-year basis is down 6%, and the S&P 500 on a one-year basis is up about 21%. That's 1 year. That's signs of deflationary forces. And I think what's happening is those autocorrelation forces in commodities, they go down because they go up, are trickling down to other assets. So I don't see this as something as a one-off. It looks like it's just getting started. And then you tilt over. Why? Well, here's one good indication. The 10-year note yield in China is 2.15%. That's compared to 3.79 in the U.S. So China's heading towards a pretty severe deflationary recession if you watch their bond yields. And I think that's what's happening. And it's happening globally. So commodities have basically been predicting this. I think we're just seeing a little bit of trickle down from the stock market that's way elevated. Now, I'll end with this. The Bloomberg, the 200-day moving average on WTI crude oil is about $78 a barrel. In markets, that's tilted lower. We're right now about 73. The 200-day moving average on the S&P 500 is 5,000. And the S&P 5 index is about 5,200. We're just potentially going to revert there. And commodities were kind of a good indicator for that. And Bitcoin was one of the quickest indicators, I think, for what's happening.
So for WTI crude oil, let's just continue there, Mike. Is it a supply issue driving this pullback here, or demand, or maybe a little bit of both?
All the above. The first thing you have to remember is the key force that pressured crude oil since the peak in 2008 is that the excess of supply and demand out of the U.S. and Canada is accelerating. It's about 6 million barrels a day. In 2008, it was a deficit about 10 million barrels a day. That's about what you see from that increasing excess of spare capacity out of OPEC. So see the bad trend there? And prices remaining high because of geopolitical tensions are keeping that force intact, meaning the cost of production in the U.S. is around $55 a barrel, and Canada it's around $60 a barrel. So you keep prices above those levels, they'll just produce more, and it's reducing demand. Diesel demand in this country is in a downward recessionary trajectory, and I hear it's the same in some of the other countries, most notably China, just harder to measure. So that's the problem. Geopolitical tensions are keeping it elevated, and it's just going to be pushing back towards its cost of production in the U.S. if all the rules of economics apply. So I'll give you one example. The number one measure of heat, electricity, and fertilizer in this country, natural gas, has already done that. It dropped to And earlier in the year, the levels that were first traded in 1990. Corn has already done it. Corn has dropped to a level first traded in 1974, back down to $4 a bushel. So this is just normal in commodities, but it's deflationary because they went up too much. The question is how normal it is for stock market volatility to bottom and stock markets go down. And that's what really pressures crude oil. When stocks go down like this, it'll bring down crude and copper.
Another corner that you keep a close eye on is petroleum futures. So you were talking about in a note recently how managed money, when you're looking at the hedge fund positions in particular, are set up for a bear market. And then obviously when you were pointing out too how the stock market mean reversion might be a particular deciding factor, what does this mean now moving forward, now that you're seeing stocks under pressure here?
Yeah, so I think that's part of the main reason, despite the imminent attacks and more violence in the Middle East, which might curtail supply, despite that overhang in the market, crude oil is going down, and despite the market has really sold out, you mentioned from futures, it's going down partly because beta is going down. It's the power of beta. When the stock market goes down like this, it's all that matters. So this is something that's really been a great indicator this year. If you watch these speculative futures traders, when they get way too long, usually it's when the market peaks, and that's what happened this year. And when they sell out, they typically don't get short petroleum futures, but when they sell out to levels that are basically flat, it typically marks a bottom. Well, that's what happened this year. And now we're kind of in that range is what's the next key level. So in our next key step too, in WTI crude oil, there's like a line of sand support around 70,000. I think it's a matter of time it follows that, it goes below that level. Natural gas has done it, corn has done it. But right now, what's keeping it elevated is futures are basically sold out. We kind of have to reset those positions, and those geopolitical tensions are keeping things somewhat elevated.
All right, Mike, great tour de force. Really appreciate it. Mike McGlone, Senior Commodities Strategist, Bloomberg Intelligence. Zooming in from somehow he scammed this Miami, Florida. I don't get it, but he's a winner. He is a net winner during this whole global relocation. That is for sure.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.